What if you could stop trading your time for money and just let your money pay you every single month? That's the promise of dividend investing. And most people think it takes 40 years to get there. But today, we're breaking down the fastest way to actually make it happen. Let's get into it. Here's the deal with dividend investing. You buy shares in companies that regularly pay out a portion of their profits directly to shareholders. Those payments are called dividends, and they hit your account whether the market is up, down, or sideways. That's the part most people miss. You're not waiting to sell your stocks at the right time. You're getting paid just for holding them. Warren Buffett has been doing this for decades, and it's a huge reason why he's one of the wealthiest people on the planet. The strategy works. The question is just, how do you speed it up? Step 1. Know your number before you do anything else. This is the most skipped step, and it kills more dividend strategies than anything else. You need to figure out how much monthly income you actually need to cover your life. Let's say your bare minimum is $4,000 a month. That's your target, the number your dividend portfolio needs to hit. Once you know that number, you can reverse engineer everything else. Step 2. Focus on yield, but don't chase it blindly. Dividend yield is the annual dividend payment divided by the share price. So if a stock pays $2 per share each year and trades at $40, the yield is 5%. Now here's where people go wrong. They see a stock with a 15 or 20% yield and assume it's better. It's usually not. Extremely high yields are often a red flag. They can signal a company in trouble, propping up its dividend to attract investors before cutting it entirely. What you want is a sustainable yield in the 4 to 8% range from financially healthy companies. Think established sectors like utilities, real estate investment trusts, consumer staples, and financial companies. These tend to produce reliable, consistent income over time. Step 3. Reinvest everything in the early years. This is the fastest legal hack to grow a dividend portfolio. When your dividends hit your account, don't spend them. Reinvest them immediately to buy more shares. This is called a dividend reinvestment plan, or DRIP. Here's why it matters. More shares means more dividends next quarter. More dividends next quarter means you can buy even more shares. Over time, this compounds into something seriously powerful. The first few years feel slow, but around year 7 or 8, the growth starts to feel almost automatic. Step 4. Increase your contributions aggressively while you can. Compounding is great, but it needs fuel. The more money you put in during your early years, the shorter your timeline to financial independence. Even an extra $200 or $300 a month added to your portfolio can cut years off your timeline. Look at subscriptions you're not using, find ways to increase your income, and redirect that money straight into your dividend portfolio. Every dollar you invest today is a future dividend payment. Step 5. Use tax-advantaged accounts wherever possible. This one is huge, and most people sleep on it. If you're holding dividend stocks inside a regular taxable brokerage account, you're giving a cut of every payment to the IRS. But if you hold them inside a Roth IRA or a traditional IRA, your dividends can grow tax-deferred or even tax-free depending on the account type. That means more money stays in your portfolio compounding for you, not going out the door every April. Max these accounts out before you go anywhere near a taxable account. Step 6. Diversify across dividend-paying sectors. Don't put everything into one company or even one sector. If a single company cuts its dividend, and it happens, you want that to be a minor inconvenience, not a crisis. Spread your holdings across real estate investment trusts, dividend ETFs, utilities, dividend aristocrats, and international dividend payers. Dividend aristocrats, by the way, are companies that have raised their dividend every single year for at least 25 years. These are businesses with proven track records of putting money back in shareholders' pockets through good markets and bad. Step 7. Have a clear exit strategy. Know when to flip the switch. At some point, you stop reinvesting and start spending. That transition is the moment you actually retire on dividends. Before you get there, make sure your portfolio's income covers your monthly number with some breathing room. Because markets shift, dividends can fluctuate, and inflation is real. A buffer is not optional. It's part of the plan. Most financial experts suggest your dividend income should exceed your monthly expenses by at least 20 to 25% before you stop reinvesting. Now let's talk timeline, because this is what everyone wants to know. If you're starting with nothing and contributing $1,000 a month at an average yield of 6%, reinvesting the whole time, you're looking at roughly 15 to 18 years to reach $4,000 a month in passive income. Start with $20,000 already saved and push contributions higher. That timeline drops significantly. The point isn't that it's instant. The point is that it's a real, achievable path that doesn't require you to win the stock market lottery. You just need a clear target, consistent contributions, smart stock selection, and patience during the compounding phase. This is general information, not financial, tax, or investment advice. Everyone's situation is different, so talk to a qualified financial advisor before making any investment decisions. If this video helped you understand dividend investing even a little better, hit subscribe and follow us at Fine Print HQ. We break down the financial and legal stuff that actually affects your life every single week. The stuff they don't put in the brochure.